Welcome to Master Trader's Weekly Trade Review. I'm Dan Gibby, and in this lesson I'm going to show you an amazing volatility options strategy that we actually use all the time, but this particular environment with the recent sell-off in the market created phenomenal opportunities for us. I'm going to teach you that in this very simple lesson. Now, when we sell options, we're giving the option buyer the right to buy or sell the underlying stock. So when we sell them, we take the premium paid and we have the obligation to buy the underlying. And since the market sold off, we're going to be focusing on this lesson in selling puts and selling put spreads around compelling reversal patterns. And I say that we can earn a weekly and monthly paycheck by doing this. And the reason I have this little melting ice cube over here is because options are time decaying instruments. When somebody buys an option, the price they paid is decaying. The underlying has to move or they lose value. And we take that benefit and we are making money through time and, of course, as the stock moves in the intended direction. So I write here, we're literally getting paid to predict where a stock's not going to go. Now, we'd have directional stock and option trades, but I'm not focusing on that today. So we do buy options, but today I'm totally focused on selling them. We do them with our technical approach, which I'll show you. This is the key, at least for this fabulous exercise here. The high implied volatility is preferred fear news earnings. So last week it was all about fear. We'll get to that. And once we're in a position, then we manage them. So we can do nothing, let it expire worthless, or if you don't mind taking assignment of the underlying stock, you do nothing. And you're buying the stock or ETF at wholesale prices. You can adjust it, hedge it, roll it. These are all things we teach in our options courses. As I said, we do these every single day, but this market environment set up amazing opportunities for us. So this is just a little snippet of the S&P 500 ETF, SPY. And we had this ugly reversal. We had a gap down. We had a bearish bias. And then on the Monday morning, we had a monster gap down. So the fall from here to here, and I'm going to show you what volatility did, I'm calling this a mini crash. And it's since, as you can see here, retraced a very nice amount. Now we have 3 separate advisory letters, but we trade options in these 2. The advisory swing and options trader, we trade stocks, options, it's ETFs, and we do them long or short. We buy or sell. And we were 11 for 11 last week in this amazing opportunity that was set up. In the weekly options trader, we sell options or spreads that they expire in 10 days or less. We do them around our master trader technical turning points. We were 18 for 19 based on this setup that I'm showing you right now. This is what's called the SIBO Volatility Index, the VIX. It very simply just measures the amount of implied volatility in out-of-the-money S&P 500 options. Okay, let's keep it really simple. You cannot trade this. It's just a mathematical calculation. And we call it the fear index because when this thing rips higher, that means that people are fearful, they're scared, they're speculating that the market's going to go lower, they're trying to hedge their portfolio. All of those things are rising the price of these premiums. And that makes this strategy at this time even more amazing. This, I had to go back to a weekly chart here to show you how high this went. So the 20, this was the COVID spike. When the markets capitulated in this strategy I'm showing you, we did the same thing with amazing accuracy during the market sell-off at this time. So when this thing spikes like this, we are looking for a bullish reversal in the SPY, the broader markets. And then our strategy is to sell puts or put spreads on these index or sector ETFs. We did them on many sectors, like the semiconductors, for example, are very liquid. We like doing that. And bearish option strategies on the VIX and VXX as an ETF. So this was last week. I'm going to show you a daily chart here. So the weekly chart, look at this thing. It spiked to 66. So we are getting ready for this strategy. I have a specific course, a volatility course that teaches you how to trade these products, ETFs, options on VIX. It is amazing. Go to the website, read the bullets, and we're offering you a tremendous discount. So this is the same spider I showed you on the other chart. So here's our gap down. This is an intraday chart. So on Monday morning on this gap down, here's my gap down. We are watching in our live green trading room, watching to see what it's going to do. Could it have sold off and continued its plunge? Absolutely it could have. But we're just sitting on our hands waiting for a reversal and a tradable opportunity using this strategy I'm sharing with you. The first 15-minute bar is a nice green real body. Once we took out the high of the 15-minute bar, we started these strategies. Shorting index and sector ETFs, naked or spreads. I'm going to show you the VXX trade momentarily. Now, the 4 index ETFs obviously are spiders, Qs, diamonds, and IWM. The Qs actually had a better setup for us because it sold off more leading into the gap down. Notice that it's under the 200, so notice that I have a bigger wide range bar here on the 15-minute chart. So we actually did this one. We gave this to subscribers, and whenever we give a recommendation to sell a naked put or call, which we're not talking about today, that would be on topping patterns, then it is always acceptable to do a put spread because that lowers the capital required at the brokerage firm, and it also is a smaller maximum loss in the event you have to stop out or a big significant gap against you. The only reason I went naked on these was because I wanted to keep a bigger premium. So hypothetically, if I sold the 415 and then bought a 405, for example, that would be what's called a $10 wide bull put credit spread. I might only then get 40 cents because all the premiums were very high, inflated because of this elevated VIX. So I wanted the big number. Now we only sold 1 contract here, or 2 contracts rather, and so we booked just in 2 days, $153, 2 contracts. We sold them at 91. Had you sold 10 contracts, $910 would be immediately deposited into your brokerage account, which is yours to keep. It's not profit yet, but it's yours to keep because remember what selling a put does? You receive the premium and you have an obligation to buy the underlying. 1 contract represents 100 shares on or before expiration if the put buyer exercises that. This is a closed trade. We give the stock or ETF, we give the date, we give the symbol. We always give the technical setup and of course the stock or option strategy. So this was a bullish gap and snap far from the 20 period moving average, and we're playing the snapback like this from a climactic buy setup. So we immediately closed half at 30 cents, back half at 2 cents, But remember on the other slide, we did 19 of these. I'm just showing you a couple right here. So this is now the VXX, which is the Volatility ETF. The fund manager of this instrument has to create this fund by buying and selling and rolling the VIX futures contracts. I get into this in great detail in the volatility seminar that I referenced here for you. This was our gap up the same day the spiders gap down. Look at that, to $90, far from the 20-period moving average. As soon as we got this 15-minute bullish reversal bar in the Qs and spiders, broader markets, the strategy says, now I want to sell naked out of the money calls or bear call credit spreads. But the same reason I went naked is because I wanted to keep a big dollar amount of premium received. Of course, you could have done the 120 and bought and did a bear call credit spread, but you're going to get significantly less net credit. You might be sitting there saying, what is this whack-a-mole picture here? What on earth, Dan, does that have to do with this? I'm going to tell you what it has to do with it. Because of the way the fund manager has to create this fund, it has what I call perpetual headwinds. So if you look at a weekly and monthly chart of the VXX, and they're levered cousins, I say, they are in perpetual downtrends. Whenever this thing spikes up, far from the 20, in the broader market, spiders are climactic buy setups far from the 20. This is a phenomenal strategy. So right here, when this thing started falling, we shorted the out of the money 120 calls. Folks, let's just use round numbers. So let's just say it was at $85 when I sent this to subscribers via Telegram. The 120 calls are $35 higher. As long as VXX closes below $120 short strike on or before expiration, which was only 4 days, one contract would have brought you $415. 10 contracts would have brought you $4,150, and it is 35 points higher. Whack-a-mole. You don't do it into a moving train. You do it when you get a reversal in this and the spiders. Whack-a-mole. We went ahead and closed it on this reversal. Guess what, folks? The same time I closed this, I sent out a new alert to subscribers. Let's do it again. Let's short the 120 calls expiring 8/9 for $4, just a limit entry, $4 a share. We got filled on this little rally into the end of the day. Sold them for $4, bought them back at 20 cents, and this has these headwinds timed with the spiders, $675. So the green one we did here, red one we did there. These are just a couple of others. I just grabbed a screenshot, all open and closed trades for our subscribers and our 3 advisory letters. We track them in the members area. You see everything we do. These are closed trades, but every single one of these, SMH is the semiconductors, same wide range reversal. We sold a $5 wide put spread here to 19% return on capital, 2 days. The diamonds, another index ETF, we did the same. Zulu Sierra, individual stock, did the same. Duolingo, Costco, individual stocks, we did the same. Diamonds, we did it again down here. We did a second one. So this explains why we were 18 for 19. We do the same strategy every day. If you want to learn more and like getting trades like this, This is a very amazing service, as I said, selling options and spreads around turning points that expire 10 days or less. Go to mastertrader.com/weekly options. Any questions? Email me. Hope you learned a lot. Take a free trial to our live green trading room, and also check us out every Wednesday at noon on YouTube for free Master Trader Live. Good trading. Look forward to seeing you in the next trade review.